Hello, everyone, and welcome back to another episode. I'm your host, a millennial investor, and today we're going over the company that I increased. In fact, we actually increased two companies. If you didn't see my last video, hopping into M1 Finance Dividend Growth Portfolio here, we have 20 holdings, and one of them was recently decreased. It originally had a position of 5% target weighting in the portfolio, which was ticker symbol KMB Kimberly-Clark, and was lowered down from 5% down to 3%. Now, the 2% that was lowered from this, 1% was added to two different companies, and one of those is WP Carey. So in this video, I want to talk about why I decided to increase this holding, why I ended up taking some of the funds from Kimberly-Clark and focusing it more towards WP Carey, which is now tied towards the largest position in the portfolio, currently sitting at double digits, 10%, which increased the dividend yield of this portfolio, and I think increased the long-term opportunities moving forward. So if you haven't seen me before, thank you for tuning in. My name is Jordan. I'm a millennial investor, and I track my portfolio balance since starting my YouTube channel at the first of every month back with my $1,500 investment in April of 2020, and how I've increased it every single month going forward, even despite this horrible recession, and my current growth portfolio holdings, which changes all the time, with my largest right now being Salesforce, then Amazon, then Crocs, and then Tesla puts. Now, we also have my portfolio balance as of the time of me filming, which is about $36,150, as well as my performance year to date, which is updated at the beginning of each month, once again on the 1st. So thank you guys so much for tuning in, and if you want to see this portfolio yourself, if you want to take a look at these two different portfolios that are shared in M1 Finance, that's brokerage, that is shared down below in the description. And speaking of the brokerage, we also have opportunities for referrals to get $10 to get signed up, which 125 people have done so far. But without further ado, thank you so much for tuning in, and let's go ahead and get started with WP Carey, ticker symbol WPC, the stock that I decided to increase in today's portfolio changes. Now, if we look at the annual chart for this company, you see that it has a long-term track record of growing its revenue, as well as growing its free cash flow. And I've talked many times before how REITs, which are real estate investment trusts, run at a very lean business model. They don't have any research and development. They have really no sales and marketing. They're really just a company that buys properties, rents them out, and then collects the profits, and they're legally required to pay out 90% of their net income to shareholders. Now, this free cash flow is really what you're looking at. This company consistently has been raising its free cash flow that it's able to produce over time, as you can see from this long-term quarterly trend. Last quarter, they produced about $210 million in quarterly free cash flow, and they consistently paid that out in dividends, as you can see, which they've had a long-term track record of raising that dividend, which we'll look at in just a moment. Now, if we hop over to WP Carey Investor Relations page, I made a video about this company about a month ago, and it is one of the highest quality real estate investment trusts, or REITs, that I can find out in the public markets. It is incredible in my opinion, and honestly my favorite REIT stock that I can find in the entire stock market. Now, they currently have about 1,400 properties across 170 million square feet. Their annual rent, base rent, is $1.34 billion. 99.1% of their properties are occupied, being rented out, so less than 1% of them are vacant that they're looking for someone to purchase. Across 386 tenants, they have 99.3% of those with built-in rent escalation. So if you don't know what that is, basically, as inflation rises and rents tend to go up along with everything else, like basic food prices and gasoline and your home, all those things that they go up, this is already factored into the rent. So if they have leases that are 10, 15, 20 years out, they already have rents that scaled up and go up every single year alongside it. So they're not missing out on that revenue opportunity and, of course, the profit opportunity. Now, they're diversified between all different types of geographic locations as well as property types. Now, they're located mostly in the United States, which is mostly what I want, about 2/3 in the United States, and the rest making up Europe and other, mostly in Europe. Now, the different types of properties are mixed pretty evenly between industrial, warehouse, office, retail, self-storage, and other. And it goes further than that. Not only are those different types of properties built all across the country in all different locations and all different sectors, but the specific industries that they're in diversified massively, okay? From retail stores, consumer services, beverage and food, automotive, grocery, healthcare and pharmaceutical, cargo transportation, hotel and leisure, construction and building, business services, capital equipment, containers, packaging and glass, durable consumer goods, sovereign and public finance, high-tech industries, insurance, chemicals, plastics and rubber, non-durable consumer goods, banking, metals, aerospace and defense, telecommunications, advertising, printing, and publishing, and then, of course, other. You can see that they're in many different industries, which is something I want to see. Because if this company had all of their money in one basket, say if they just had insurance companies, then if something happens to the insurance industry, then they're out of luck, right? They're going to go down big time. Or if they had all of their money just built just strictly behind hotel and leisure, like during the pandemic, then this company would really struggle. But since it's each and every industry only makes up a small slice of the pie, the biggest one being retail at only 20%, 1/5 of the pie, that really doesn't matter that much because no matter what happens, you are automatically diversified out of industry-specific risk because we're so spread out across different industries. Now, furthermore, they also have top 10 tenants that are diversified specifically based off of their rent. This only makes up 18.4% of their annual base rent, or ABR. And you can see that these are in different categories, different groups, whether it's talking about state governments or U-Haul or Advanced Auto Parts. There's many different names here that are in many different categories. As you can tell, and most of these you can see have many years behind them. Many of them have 10 plus years, like 10.6, 12.9, 21.2. The longest one on here is the 21.8 from Extra Space Storage Incorporated, which is just crazy to think about. That's almost my age. I'm 23, and that lease still has about 22 years left, which is crazy. And here's a map I would recommend if you want to go on their investor relations page and look at this yourself. It's really cool. You can click into each country, and it will show you how many properties and the types of rent that they have and all types of cool stuff like that. So check that out if you're interested. Now, this company has had a long-term track record of returning capital to shareholders as it is forced to by law per the federal government. Now, the federal government requires that REITs, or real estate investment trusts, return 90% of their profits back to shareholders in the form of dividends, which is why this dividend consistently grows and is very high over time. Now, you can see if we look at NASDAQ.com here and we look at the long-term track record, how far does this go back? This goes back to 98, from 41 cents up to 50 to 90 to $1, all the way up to today's $1.05. Now, you can see that this is not raised annual, but every quarter. Each and every one of these little ticks here is every 90 days. So every 90 days, not only are you getting a check, but it's an increasing check that has been raised over and over and over and over again. And this leads me to why I decided to lower Kimberly-Clark and increase W.P. Carey. The one benefit to owning Kimberly-Clark was that it had a stable dividend. It was a very defensive stock. And they did raise that dividend slowly over time, and the company is very defensive. Once again, it's a need-based business. But a company like W.P. Carey has a higher dividend yield. So let's go ahead and take a look at Kimberly-Clark's dividend yield, which currently sits at 3.78%. That's pretty solid. That's pretty good, and it has decent dividend growth similar to that of W.P. Carey's, growing a couple percent each year. But this company will pay me 3.78% for every share that I buy. Meanwhile, W.P. Carey will pay me over 5%, about a full 1.5% higher than that of Kimberly-Clark. And so when I think about opportunities to buy companies like this on a dip, because if we look year to date, this company is actually down, which is very rare considering this company almost never goes down. And this company is not only at a time where it's at a dip, but it's at an extremely high dividend yield. So this is one where I want to take advantage of the opportunity. While they've currently diluted shareholders, this is the time to be buying in my opinion. And while the stock price is down, you get to take advantage of that awesome free cash flow that the dividend is likely going to provide you if they're able to keep that up. But other than that, guys, thank you so much for watching. I appreciate you watching all the way to the end. Check out all the stuff down below in the description, including the M1 Finance referral, which gives you $10 for signing up. Thank you so much for watching, and I'll catch you guys next time.